Good afternoon, everybody. We're going to give it like another maybe 30 seconds here before we get going. We got some people coming in right now. And first, I just want to thank everyone for joining me. You're taking time out of your afternoon or evening, depending on where in the country you are, to spend this time with me. I want to remind everybody that on the bottom of your screen, you're going to see a chat box there. And please ask as many questions as possible. I always got about 20, 25 minutes worth of material that I like to go over, but I think some of the best commentary that we've gotten as we've done these in the past has come when those of you that have been watching these things ask questions, and we are open to any and all questions. So again, thanks for being here. I guess I'll start with this. When we did this at the end of the third quarter, my theme at that point was, can we have some sort of cautious optimism here after the kind of year that it was in the first three quarters? And my answer at that time was, I think so. And so far, that's proven to be mostly correct. The fourth quarter for sure last year, and so far the start of this year, it's felt a lot different. And the numbers have definitely justified the fact that it has been a lot different than the beginning of the year. So we're going to start with this, basically. We're going to touch on the themes in 2022, what was on investors' mind, what were people thinking about. Then we're going to spend the time talking about the bond market, because I really think what happened in the bond market was the number one issue, at least financially speaking, that occurred in 2022. Going to touch on the equity markets. And then obviously the gorilla in the room, or the elephant in the room probably, is what the Fed's been doing over the last year. We're going to talk about inflation. Are they getting ahead of inflation? And also spend a little bit more time on real estate, because we have gotten a number of questions about what's occurring in the real estate markets. Then we're going to look at 2023 concerns and opportunities that are out there. And then finally, Q&A. Really wanted to take your questions at any point throughout this entire presentation. As we get through each of these sections, I'll be taking a pause to see if anyone has any additional questions. But please, fire any questions that you might have, and hopefully we've got some good answers for you. So let's dive into it. 2022, obviously very interesting year. We had Chris Rock and Will Smith slap situation. We had Elon Musk, obviously the Queen, passing away. So it was a pretty interesting year in terms of the different personalities that were involved. But the personalities were less about what people were really, that wasn't as much what people cared about. If you just look at search interests throughout the year, throughout 2022, Great Resignation, interesting. Beginning of the year, a lot of interest in the Great Resignation. Toward the end of the year, it kind of turned into layoffs. So that sort of dissipated a little bit. The Russian stock market, as the invasion of Ukraine occurred, a big one. Oil prices, the housing bubble, value investing, Bitcoin, recession, inflation, US dollar, OPEC, layoffs, interest rates. So the point is, there was a lot of stuff on people's minds last year. And of course, a lot of it was reflected in both the news stories that we saw and what occurred in the financial markets. But in my view, there was really nothing more important, at least financially, that occurred last year than what occurred in the bond market. So we're going to start with bonds. Now, this is a chart that I've shown people in the past, usually as it relates to stocks. So I really want to say, again, if you have any questions on these charts as I move through this data, please stop, pause, ask me questions, because really gratified by the feedback we've gotten from doing these every quarter. We've got more people tune in generally every single quarter. We've gotten a lot more views on the recording. And so we appreciate the fact that people find value in this. But one of the criticisms that I've had is, hey, you're firing through all of these charts, spend some more time on it, or really try to bring it down to sort of base level here. If I don't do that, I really invite you all to come in and ask any questions about any of this. But this is a chart I've showed in terms of equity markets throughout my entire career. I never bothered to show it for the bond markets. And what is this thing? This is basically going back to 1976. This is looking at overall returns in the Barclays Aggregate Bond Index in this case. The gray bars are the net returns for the year. As you see, a lot of these returns are positive, sometimes significantly so. Those red dots with the numbers underneath, this is the maximum drawdown. So at any given point in the year, the markets can rally, they sell off, they rally again, that type of thing. The red dots represent how much these markets sold off in a given calendar year. Before last year, you got to go back to 1979. We saw bonds still made about 3% in 1979, but you had a 9% drawdown in the Barclays Aggregate Bond Index. And again, the bond index, we're talking the broadest measure. Think the Dow or the S&P 500 of investment grade fixed income, corporate bonds, treasuries, high grade fixed income. Last year, we at one point had a 17% decline in the aggregate bond index, which is almost double anything that we've seen in the past. And bonds for the year in terms of investment grade fixed income down 13%. That's a really, really historic number. And what it did mean is, in a year like last year, where usually you have tough years in the markets. They're a lot more common in the equity markets. Your fixed income portfolios buffer that downside a little bit. That didn't happen last year. The fixed income actually added to the volatility, which was definitely unique. And we're gonna touch on how really unique last year was. And in fact, if you're looking at the 10-year Treasury bonds, kind of the benchmark, the United States federal government has been issuing bonds since its inception. And the 10-year Treasury bond had its worst year last year since 1788. Okay, so you're talking 1788, what happened? The Articles of Confederation collapsed and we're basically doing a new constitution at that point. You got to go back a long time to find a year in the bond market like we had last year. It was pretty dramatic to say the least. And what was really driving it, obviously, the Fed, which we're going to talk about, raising interest rates. But this 40-year time period, basically 1980 to 2020, this 40-year time period where you saw interest rates, generally speaking, declining, ups and downs, of course, but overall declining, that pretty significantly came to an end last year. If you see this really significant breakout in interest rates, rates essentially went almost to zero around COVID, but it broke out of that downtrend that we've had for 4 decades. Now, do I think that we immediately go back to 10, 12, 15% rates like, you know, people that were around in the markets in the early 1980s, late 1970s? No, I don't think that we're going to go there. And there's a lot of reasons that I don't think we get that high. But we've definitely seen kind of this end of 1 to 2% interest rates. Now, overall, I actually think that's a good thing. We had pain getting there last year, but I got to tell you, if people or clients were coming to me a year or so ago and saying, hey, I've got some cash, I want to keep it liquid, I don't want to take a lot of risk, what do? The answer is just leave it in money market. Now you can go out and buy CDs, you can buy treasuries and get north of 4%, essentially as close to risk-free as you can possibly get. But this kind of regime of zero or pretty close to zero interest rates, you know, this 40-year downtrend was broken. It was broken in a big way last year. And so the bond market to me was the big story. Any questions on that before I kind of dive into the equity markets in terms of what went on last year? Okay. Again, please, whatever questions you possibly have, feel free to ask them. Nothing is out of bounds. So the equity markets, you know, I'll go back to this chart. It was a volatile year. It was a downside year for sure in terms of stocks, but it wasn't historic like it was in the bond market. Normally, in terms of the equity markets, you know, 7 out of 10 years are generally speaking going to be okay. You're going to have 3 that are going to be difficult. One's going to be really challenging. And a 19% decline in the S&P 500, which you see we had last year, you know, it's not good, it's not pleasant, but it's not unprecedented like we saw in the bond market. But again, this same chart to give you an idea, this is the S&P 500. Gray bars represent what total return was for the year in these given calendar years. The red dots represent how much these indexes sold off from peak to trough. What I always find interesting when I look at this is you see this negative 34 down here in 1987. Everyone remembers the crash in 1987. What they don't remember is actually the stock market was up 2% that year. You had this massive intra-year decline, but the market did end positive for the year. But last year we saw a 25% decline at one point in the S&P. It was much worse for the NASDAQ. NASDAQ was in excess of 35, almost 40% at one point. Settled down about 19% or so. So big down year for sure, but certainly not out of the realm of what is pretty typical in terms of equities. Now, this is a chart that I showed you back in June, and I think it's really interesting. How many people felt really great about the economy last year? The answer is actually a historic low number of people felt good about the economy. What we're looking at here is consumer confidence. And so if you see over on the left-hand side there, February of 1975, for example, that blue dot, that represents a low in consumer confidence. People are feeling terrible about the world, terrible about the markets, terrible about the economy. What you find is when people are feeling the worst, that tends to be a pretty good time to be an investor. So we hit this low point in February of 1975. Next 12 months, market is up about 22%. Until last year, the most historic low that we had seen in consumer confidence was actually in 1980. You had the lowest recording we'd ever measured for consumer confidence. The next 12 months, market's up 20%. 1990, think Iraq War. People were concerned about that. Market is up 29% off that consumer confidence low. And you see this pattern pretty much is repeated for the last 30 or 40 years ago. In June of last year, and I recall it was like a day or two before I did this presentation in June, we hit an all-time low in terms of consumer confidence. Now we are above the lows. I think the S&P at that point was trading about 3,800. We're about 4,100 or so right now. So we are off those lows. The first 6 months, at least, off those consumer confidence lows have been pretty good. We're going to find out what the next 6 months bring. But I will say when people are feeling worse about the economy, that tends to be a time where it's, excuse me, it's a pretty good time to be an investor. And now this, I won't spend a ton of time on this, but I get questions a lot. Is the market fairly priced? And the answer is there's so many different metrics that you can look at in terms of whether the market is fairly priced or not. But when you see this kind of blob of dots, what you really want to think is if you're looking at the extremes out here, the market's either super cheap or super expensive based on price earnings. And we're kind of sitting right in the middle, which really means that, the market, it's been more expensive, a lot more expensive at some points. It's also been a lot cheaper at other points, but we're kind of right in the middle. So we're not getting much data from that. This is a really interesting one. I showed this last time as well. In the 1990s, then you see that big spike up in this chart right around 2008. This is S&P 500 price to cash flow. So what you found is, particularly since 2008, and even from the excesses of the 90s, corporate America has actually been pretty darn smart, and they are running much more lean, much more efficient operations. So what you're seeing, although PE levels are probably pretty consistent with being average at this point, price of stocks to cash flow is actually really historically cheap, and that's just what this is showing. If you look at the spikes in that reading, companies aren't generating much free cash flow. Stock prices obviously are trading at huge multiples of that, but by this measure, the market looks relatively inexpensive. And okay, next one. Oops, sorry about that. So small cap. So those that are clients of ours might notice we've had some small sleeves and small cap on in the past. There's more of it now. We put more in pretty much across the board, most of our portfolios in January. And here's the reason, because if we've talked about the fact that the S&P 500 is historically pretty much fairly priced, US small cap stocks are historically really, really inexpensive, particularly in regards to earnings. If you look at this chart, obviously they were incredibly cheap, as pretty much everything was during the financial crisis. But we're back to levels that you haven't seen in 2008, 2009 in terms of price earnings ratios for small cap stocks. And I think that there's a lot of value there, not just from a evaluation standpoint, but I think there's a lot of really good things that are happening in the economy that will benefit some of these smaller companies. And now finally, we've talked about this in the past as well. Pretty much since the Great Recession, US large cap stocks have been the name of the game. That's where most of your outperformance has been. International stocks, generally speaking, have lagged. What this chart shows us is there's periods of time, and sometimes they last just a couple years, sometimes they last 6 years, sometimes they last longer, where international stocks really take over and really shine. Now, when that transition occurs, I'm not sure, but if you look at, I had some other charts up in terms of valuations of international securities. I pulled them out. I thought it was a little bit too kind of wonky to put in here. This trend at some point will change, and those that are clients, you might have noticed a little bit more international that got put in the portfolios. And this is why I just think there's a really compelling valuation story to be told about investing in countries outside of the United States. And I think that this really long period, this historically long outperformance rather, of US assets, there's lots of reasons to believe that could potentially change moving forward. And finally, again, those are clients. Pretty much none of you have seen emerging markets in your portfolios until this year. It's been a good thing they haven't been in your portfolios. If you look at emerging markets, for example, as an asset class, back in 2008, had you and emerging markets, by the way, coming into the financial crisis in 2008, had outperformed US markets significantly, almost threefold. Since that point, they've basically done nothing. You've had this red line represents US equities, generally speaking, been really good since the GFC, great financial crisis. Emerging markets, basically you're pretty much even after a long 15-year hold period. Again, based on valuation, based on some pretty compelling stories that are out there. For the first time in a long time across the board, we added a pretty small sliver to emerging markets to our portfolios as well. Any questions on any of this before I continue? Okay. So all this considered, what did this mean for a balanced portfolio last year? Well, it was tough. Last year for a balanced portfolio, we're talking 60% equities, 40% fixed income. It was as tough as 2008, depending on what measures you're looking, even tougher. And the reason for that is, although equity markets were down a lot more in 2008, you made money in bonds because interest rates fell pretty dramatically. That wasn't the case this year. So balanced portfolios, they took a historic hit. You're looking at, you got to go back to 1971. You've got to go to 2008 to see what to look for a comparison anyway, in terms of the kind of year. And I'm a data guy, and I'm definitely a visual guy. And I think this really illustrates it well, is this specific chart right here. Everything in the upper right-hand quadrant, that is generally good stuff. And that's what happens most of the time in the financial markets. This means stocks are up. This means bonds are up. This means the world is pretty good. If you're in that upper right-hand quadrant, the world's pretty good. This lower left-hand quadrant is pretty much the worst of everything in the sense where you've got stocks are down, bonds are down. There hasn't been many of those years. They've happened, but there's not many of them. 2002 is obviously a notable example. The reason it's such an outlier is not so much because of what equities did, but because of what bonds did. But again, you got to go back to 1969, 1907, 1917. I mean, it was a historic year for a lot of reasons. The vast majority of years don't look like this, but if it felt different to you last year, it's because it really was. It definitely was. Now, one of the more frustrating answers that I give clients, because but I got a question here. It says, does it seem like the bond market is something to be avoided for another 6 months? That's a great question. And here's my take on that. When you go and buy an individual bond or a CD, you know with mathematical certainty what your cash flow is going to be. You're going to get your interest and you're going to get your principal back, unless the issuer defaults, which is why, generally speaking, we don't do much in high yield. And some of our portfolios have a sliver, but we just don't get into that market. I want bonds to basically pay me, and I want to get my money back. What's kind of interesting, what's happening in the bond market right now, which is a positive, is in the past, a year and a half or so ago, if I had a client that was sitting on a lot of money, a lot of cash, that was either earmarked for an expansion of their business, maybe to buy a house, maybe they just need to keep it on the side for some reason. Their question often to me, particularly when markets are good, was why can't we just go and invest this market and make some more? And the answer is because markets obviously are volatile. But at the time, there was nothing I could do to go get any kind of an excess yield. Now you can. I mean, we're buying CDs for clients that are yielding 4.5, 4.6% maturing in August to sit on their cash. We're buying treasury bonds for the first time since 2019, particularly for California clients. Because treasury bonds, you don't have to pay the state. You got to pay the federal government on that interest, but you don't have to pay the state. If you clip your coupons, you hold that interest, you receive that interest, you hold your bond to maturity, your cash flow is basically etched in stone. Now, what you saw last year is what people are willing to pay for that cash flow dramatically changes based on what the rate environment is. So to answer your question, bond market, I wouldn't avoid the short end of the curve. I think that the Fed's probably, they've indicated I'm jumping ahead, but they're going to probably push rates up a little bit higher. But you know, if I can buy a 1-year treasury and get myself 4.5% with essentially no risk, I mean, government's got a lot of problems. One of them is not the fact they're going to pay you back your treasury bond in 1 year. But if I can go and make that trade or an FDIC insured CD and get 4.5% for excess cash that's sitting on the sidelines, I will do that all day long. Now, am I going to go out and buy a bond maturing in 2035, 2040, way out? No, because I think you're taking way too much interest rate risk to make a bet that long. So to answer your question, I wouldn't avoid the bond market in the short-term bonds at all. Still a little cautious on the longer end of the curve. I hope that answers your question. But back to this chart. So one of the complaints that we get or observations we have, and things that quite frankly frustrate clients, and I get it, is because all year, January, February, I'm saying, you know, I don't feel like great about the markets. I think we could potentially go lower. And so the question we get is, well, why don't we just sell everything, get out, and then get back in? And the answer is because A, you don't know when the switch is going to flip. I mean, the rally that we have had from the lows in September, October last year has been dramatic. Has the macro environment, has the news cycle improved that much more? The answer is really no. But I think a lot of the negativity has been worked through the system. But the other thing is, the longer that you hold these assets, the less risky they become. And here's what I mean by this. If you're looking at this green bar on the left, this represents 1-year returns in the S&P 500 stock market. Worst 1 year down 39%, brutal. Best 1 year up 47%. In terms of the bond market, worst 1 year down 13, happened to be last year. Best year up 43%. But what you see is that downside volatility, the longer you hold these assets, disappears. You go out to 5 years. Your worst 5-year return in the S&P 500 is a 3% annualized negative return. You got to go out to 10 years to find even a 1% annualized negative return. That's happened twice. Happened 1929 and 1939 through the Great Depression. It happened 1999 to 2009. So this is, again, why if you need cash, if you know you have a spending goal within the next year or two, then yeah, you've got to keep it. You don't want to invest for what are longer term assets, but time heals a lot of these wounds, and time also tends to take away a lot of the volatility, a lot of the downside risk for pretty much all of these asset classes. But great question about the bond market. If anyone has any more, please ask. So let's talk about the Fed. The Fed was the big story last year. No question about it. What they're trying to do by hiking up rates as quickly is they're trying to get rid of inflation. The question is, are they successful at it or not? Now, in terms of what they've done, you know, this is basically looking at the Fed funds rate. This is the rate that the Federal Reserve has control of. They have the control over that overnight rate. They can push that up. They can move it down. They don't have control over the 10-year or 20-year rate, by the way, which is one of the reasons the Fed is jacking up these short-term rates 10-year rates are actually lower than you can borrow money for 10 years a lot cheaper than you can over 1 year, which is pretty interesting. But they've raised rates at a historic pace. This chart's from Monday or so. This week, the Fed raised by another 25. It was totally expected. You're probably going to get into maybe 1 or 2 more 25 basis point hikes. They're looking at bringing their key target rate up to 5 or 5.25, which is about a half a point higher than here. They've been pretty outspoken in terms of what their plan is in doing that, and they pretty much have stayed the course. We're the first time since before the financial crisis where the Fed's actually done exactly what they said they would. So they've raised rates. So the question is, has it gotten inflation under control? And I think, yeah, they're getting a handle on it. There's no question about it. So what are we looking at here? This is the Bloomberg Commodity Index. So this is a basket of commodities, everything crude oil, natural gas, to grains, to precious metals, you name it. It peaked out in June of last year when the CPI, the Consumer Price Index, also peaked out at over 9%. Since that period of time, I want you to look at this column all the way to the right here. Okay, yellows and oranges and reds mean dramatic price drops. So since the middle of June of last year, you are seeing, with the exception of the big outlier you're looking at here is soybean meal. Okay, that one is up. But all of these other core commodities, for the most part, are down, in some cases, really, really significantly. I mean, natural gas down 68% since that period of time. I mean, these are big price declines. So from a commodity standpoint, yeah, they've definitely made some progress in terms of squeezing inflation out of the system. Another thing we heard a lot about last year, the cost to ship a container from Asia or around the world, which obviously had big implications for the supply chain. It had quadrupled post-COVID. We all remember the stories from last summer of all these boats sitting off the port of Long Beach in California and just waiting to get in. The cost of shipping now, it quadrupled, and now it's back to pretty much where it was pre-COVID. So you want to get a container from China, it's going to cost you about what it did in 2020 and 2021. These huge multiples to send something overseas doesn't exist anymore. That's gotten a lot cheaper. Now let's look at the housing affordability, another big driver of inflation. So what are we looking at here? Chart to the upper right. If this line is kind of high and elevated here, this means housing is really affordable, okay, based on what you're paying every single month. This is basically you had a couple things happen after the financial crisis. You had house prices got way cheaper. You also had historically low interest rates. Housing was very affordable. So what do you see here? You see obviously a crash in affordability, meaning that houses are a lot more expensive. To illustrate this, let's assume you have $2,500 to pay on a mortgage, and you have your down payment. But at 3% 30-year rates, that's going to get you about a $750,000 house. At 6.5% rates, gets you about a $500,000 house. Now, buyers have figured this out. Buyers are stepping away. The sellers really haven't yet, but you're going to see some price adjustment in terms of that. I think that you will anyway. And you're going to see some of the inflation come out of the housing market. Now, the next question I get then is, okay, well, if we've got problems potentially coming down in the housing market, do we get a repeat of 2008 where everybody walks away from their houses and everything else? First of all, I don't think so, because the amount of rampant speculation that's in the housing market and the amount of inventory just doesn't support that. Just to give you an idea, this lower right-hand chart, this is the credit quality of people taking a mortgage out. From 99 to basically 08, you had numbers as low as almost 700 in terms of credit scores. Your average borrower now is sporting like a 768. So your average borrower is pretty creditworthy, able to make their payments, nowhere near the levels that you saw back in 2008. But I think more importantly, there just isn't the supply. So upper left-hand side here, housing inventories. Okay, this is new and existing single-family homes for sale. You see this massive ramp up starts in 2003 on this chart, continues into 2006, 2007. You had historically low quality of borrowers, so historically, unqualified buyers, but you also had massive inventory. I mean, this is the stories of people that are basically picking citrus that own 5 houses. I mean, this is what you had, and you had massive speculation in terms of builders and also in terms of consumers. What you see now is the inventory that we have in terms of housing is historically low. So although there might be a pinch in terms of pricing, at some point there's not an oversupply here. So that I think is going to protect the downside a little bit as well. Rental vacancies. Even coming into the financial crisis, you had historically high rental vacancies. So you didn't have people were building houses, they were sitting there empty. They weren't even generating cash flow. Rental vacancies well below the long-term averages. So you don't have a lot of empty houses. Single family housing starts, upper right-hand side. Okay, historically low, way below the trend lines. So you're not looking at, again, this massive amount of housing starts that you got to have the buyers there to be able to pick up that demand, pick up that slack. So again, that looks pretty good. Multifamily historically is a little bit more expensive, but again, you don't have these extremes of real estate in terms of just the sheer inventory that is out there that leads me to believe that, okay, some people bought a house in the last year and a half or so, they might see declines in terms of the equity of their house, but the inventory and everything else and the quality of the buyer doesn't look anything like what you saw in 2008. And the other thing too, I want to talk about from this inflation standpoint, this is excess household savings. Okay, that dashed line on the bottom, this is kind of your trend line here. Things are cruising along 2018, 19, 20, and then wham, you get this massive increase in savings. Well, what happened? Well, we had the federal government throwing money at everybody because of COVID. And then you also have people not spending money, not going out, not doing anything. So you had this massive ramp up in savings. Then you had another ramp up towards the tail end of 2021. You had more COVID legislation that was passed in the beginning of 2021. You had obviously different waves and everything else came in, people not spending money. So what this blue bulge is right here, this is basically peak excess savings. You normally have about $800 million in terms of excess savings. This topped out at 2.1 trillion. So you had $2.1 trillion of excess savings chasing not a lot of stuff. Couple that with supply chain problems, couple that with continued outages, continued shortages of different things. That's a big factor of inflation. So what are you seeing right now? Well, savings rates are basically dropping essentially to zero, but you're having people burning through these excess savings. And what's that going to do? I think that the crazy money that people are spending on things is not out there anymore. But also you're going to have people that had this massive pool of savings that decide they didn't want to work for the last 2 or 3 years. As those savings continue to be depleted, they're going to want to re-enter the job market, which helps with wage pressure inflation that we've seen. So I think this is a pretty big one. This excess savings, the cash that was thrown in there post-COVID is it's not gone. We're still at higher rates, but it's almost gone. So with that noted, let's take a look ahead into 2023. Before I kind of dive into this, I want to answer any other questions you might have. Please fire them in here, and happy to answer them. All right. So what are the concerns? If you basically look at the concerns that people have coming into the year, there's some pretty good ones here. Energy supply crisis, cost of living crisis, rising inflation, food supply crisis. I love the fact everything's a crisis, when you're looking at these headlines. Cyber attacks, critical infrastructure. This is one I hoped I'd never see, but deployment of nuclear weapons. I mean, when's the last time we had to worry about that? Maybe in the 1980s, maybe in the 1960s. But, so there's a lot of real concerns out there, and there are a lot of things that people are worried about and should be worried about. But I think this is pretty interesting as well. So what are some of the predictions for 2023 if you look at like what's out there in the ether? So if you're looking at articles, reports, podcasts, interviews, what are some of the things that people are saying? Because there is something to like where are people's minds at? Let's just kind of look. I'm not going to look at all these. Let's look at some of these and look and say, are these good or bad for the economy? Are these good or bad for the financial markets? So let's look at this first one I'll touch on. Actually, regulars will clamp down on TikTok. I'm all for that, by the way. I hope they do. But I'll talk about one that's economic. Energy will remain expensive. It's gotten a lot cheaper. I mean, we're nowhere near in terms of natural gas and oil prices where we were. The current administration is not friendly toward fossil fuels. We all know that. But you're still seeing a ramp up in rig count. You're seeing a ramp up in production, particularly around Texas and New Mexico and things like that. So it's probably a little harder for some of these companies to start new projects. That to me is, I don't know if it's going to remain as expensive, but if it remains expensive, that is a negative. Broad equity indexes will rise. Well, let's hope so. Let's go down here to the bottom. No Taiwan invasion. Let's hope not. That would be a real positive. I know that was something in the last couple of years anyway that people have had some concerns about. I'd really like to see that not happen. If you think we have supply chain issues right now, that would definitely really add to it. But one of the things, pro or con, that you see in terms of what's happening in Europe right now is you can bet that the Chinese are watching this very closely. I don't know that's in their best interest to do it, but let's hope that one does not happen. This is a huge one. China's economy will bounce back after reopening. One of the biggest issues that we've had in the last couple of years or so is China's COVID lockdown policy was absolutely draconian. And whether it was because their population began protesting, whether it was because economically they just couldn't do it anymore, they basically ripped the Band-Aid off. So it's like they're going, COVID's flowing through their entire country. They've moved forward out of zero COVID. In the long term, I think both for the people of China, but also for the world at large, I think that's a really good thing. It gets us much further back to normal, pretty much back to normal, if they continue with that. And it looks like they are. That's a huge positive. U.S. dollar surge has come to an end. Yeah, possibly. I think we've been at historic dollar strength last year, which started to peter off. That'd be really good for international stocks, by the way, which we touched on a little bit. Some other things that's out there kind of in the ether. Bonds are back, baby. The longer end, I'm not so sure, but the shorter end of the curve, I mean, I'll buy a treasury yielding 4.5% all day long. Why not? You're going to get your money back in a year, and then you can make another decision. Global recession risk is high. Maybe. I think that right now, if we, and by the way, from a financial market standpoint, if we go into a recession, normally by the time we're in a recession, the markets have already done what they're going to do. And usually when we enter a recession, the markets are already on the upswing. So that concerns me less from a financial standpoint, concerns me more from just a societal standpoint, because a lot of bad things happen when you go into recession in terms of people's mental health and everything else. You don't want that. But I don't know if the recession risk is as high as people think. I do think there's a lot of good stuff happening in the economy. Russia-Ukraine war will not end in 2023. Unfortunately, that's probably the case. Following Elon, Silicon Valley will slash headcount and cost. Yeah, I think that's what we're seeing it. Microsoft, Amazon, these companies have all laid off well over 10,000 people in both of those cases. And I think what that's going to do is these companies are going to get very lean again. The kind of crazy profitability that these companies have had is definitely going to change a little bit. And I do think you're going to see some of those excess workers pulled off. Let's hope interest rates will peak in 2023, lower left-hand corner. That'd be a great thing. Inflation begin to cool off. That would also be a great thing. And this one's probably, if I had to get excited about anything, it'd be this last one on the right. More manufacturing will shift away from China. I think one of the great things that has come out of the last 3 years, in a year that's brought a lot of challenges, is this. For the preceding several decades, pretty much since NAFTA, everything was about the bottom line. Let's shave 2 or 3 percentage points off the cost of something to manufacture it overseas for a lower cost. Those days are over. I think that COVID, Russia, Ukraine, a lot of the global instability has basically, ripped the mask off this notion that supply chains can't be fragile. But what happens if manufacturing comes back here? It means you have more workers building stuff. You have more jobs here in the United States. You have more, like when you're seeing the onshoring that you are seeing in manufacturing, I'm telling you, I'm talking to guys in private equity and people whose businesses are serving this space. The number one question that these companies are getting is about how fragile their supply chain is. It's a lot less fragile if it's here at home. If it's here at home, that means our neighbors have jobs. That means Americans have jobs. That means it's good for our economy. So this is a long-term benefit, I think, to a lot of the pain that we've had for sure in the last couple of years. I hope that definitely continues. And now, finally, again, if you're going to be doing business anywhere, country's got a lot of problems. There's no way, there's no question about that. But I'm telling you, you look at, again, in the last couple of years, what has this taught us? Well, Europe's kind of deindustrializing in a lot of ways right in front of us. So if you're going to build something, you probably don't want to do it in Europe. China's been incredibly draconian in terms of what they've done, both with their population and also with their companies. They're competitive for sure. They're definitely a big economic and for sure a military threat. But there's no place on the planet that is a better place to do business than the United States. And all the competitive advantages that we have done nothing but shown through, I think, more positively, even over the last couple of years. So I'm extremely optimistic in terms of what will happen, the kind of innovation, the kind of things that will happen in this country over the next 5-10 years and beyond. So with that, let's open it up to Q&A. The bond market question was a great one. If I blew through something too quickly, please let me know. If you've got other questions, I hope that I can answer them. So I'll give it a few minutes here. And if I don't have any questions, then thank you all for coming and joining me. As always, we're recording this. We're going to send out to our clients. We're going to send out the recorded the video of this rather once we get that up. The other thing too, while I'm on here, that I encourage people to do is we put out quite a bit of different content. If you pop onto our website, it's mpadvisorsaz.com. Usually about once a week, we're doing like a little 3 or 4 minute video in terms of talking about some of these specific issues, what's happening with the markets. And we definitely would like to invite you to go and check that out. We don't email it to everybody. Everybody's got enough email coming in their inbox, but it's definitely there. And we continue to add to that every single week, pretty much. We've got stuff that we've got going up there. So nothing on anybody's mind. After 2022, people, seriously, no other questions based on what's going on. Okay, I'll give it another couple minutes here, and if I don't have any other questions, then we'll sign off. But in the meantime, I'll give it a few minutes, and don't be shy, please. You can ask questions anonymously. Feel free to put me on the spot. That's always fun to do. I see a bunch of these names here, and I know there are people that have really phenomenal insight and phenomenal questions. No questions. Okay. All right. Well, I'll tell you what, I'm going to give it about another minute or so. And if no one asks anything, it's usually, at least in the past, as we've done these over the last year and a half or so, we have to once somebody asks one, and then it normally starts the cascade of questions. But okay. Another thing I'll just add while we're kind of waiting, question we've gotten lately is Secure Act 2.0. That's actually been a pretty big question, and that happened in December of last year. What that's going to do, I'll just kind of touch on this, and if we don't, I'll touch on this. If we don't get any other questions, then we'll go ahead and sign off. So in 2023, RMDH. Oh, explain crypto winter. Okay, crypto winter is a lot more exciting than a Secure Act 2.0 is pretty good actually. Crypto winter. So basically, as rough as so you're talking about cryptocurrencies here, as rough as financial markets were for investment grade bonds, U.S. equities, crypto space was absolutely decimated. I mean, you had FCX. We've done some videos about that where they basically stole client money. You had several of these tokens essentially went away. So 100% of their money was gone. Even the bellwether cryptos like Bitcoin, Ethereum, in some cases, I mean, Bitcoin went from 66,000 a token, I think, down to about 12 or 13 at one point. It's back over 20. But the crypto winter is basically that, in the sense that you had this massive enthusiasm into really the end of 2020 into 2021, where you had these tokens essentially, and we did a podcast on that actually, which is on our resource pages. But yeah, these tokens just absolutely explode in terms of value, and a lot of that money just went away. The best comparison would be the dot-com stocks in the late 1990s. If you had bought a basket of dot-coms in the late 1990s, you essentially would have lost all of your money because pretty much all those companies imploded. Okay, what do you think will happen with the debt limit issues? What happens if the parties don't agree to extend? That is a dynamite question, and I actually think that the reason that they are slower to come to an agreement on the debt limit is one of the things that's actually helping the market right now, and here's why. So the debt limit is this: Congress has to. They basically, it's like a credit card essentially, where they vote on what the upper limit of their debt is, and then once they hit that limit in terms of their debt, they've got to vote to extend it. And it usually pretty typically happens all the time. We're at a level now, we're about $31 trillion of total U.S. debt. So you've got the Republicans that have come in. They want some concessions over growth in spending. Democrats don't, at least the thinking is they don't really want to do that. There's questions in terms of where to, I don't want to say cuts because they're always going to spend more money every single year. It's really a question of how fast you grow their spending. But I think what it's done is this. So we're up to the debt limit right now. They can kind of juggle things around in terms of the finances. Secretary Yellen has said probably through into Q2. But what happens is if the federal government is not spending a ton of cash, when they spend money, they got to go out and raise the money. So they got to issue trillions and trillions of dollars worth of bonds. That sucks capital out of the system. And so if they're not out there seeking to raise trillions and trillions more, then basically, and you're not having, we don't have, the foreigners are not buying our debt as aggressively either. Chinese, Japanese, foreign countries are not buying U.S. debt to the extent that they were in the past. So I think basically putting the brakes through this process on federal spending, I think, is a real positive. So I think they're going to come to an agreement. I don't think there's political will on either side to really put the hammer down and do what probably needs to be done in Washington. But you know what? Here's the thing: with federal government, when they say a federal government shutdown, basically that's shutting down everything except for what they view as critical services. And the critical services are most of the stuff that we interact with on a day-to-day basis. They will make a big show out of putting barriers in front of some public monument saying you can't get in there. But I think it's necessary that Congress have this discussion, because you can't spend money to the extent they have indefinitely. I mean, our debt was about 17 trillion, I think, when Trump came in. When Obama left office, and we're at 31. These aren't sustainable numbers in terms of debt. So I hope they do have that argument. Great question. Any other questions like that? Okay, I'll touch again on Secure Act 2.0. If I don't get any other questions, then we'll sign it off. But please keep the questions coming. I love answering them. So Secure Act 2.0 passed in December. I think this is a pretty good piece of legislation. Basically, what it does is it increases the RMDH for retirement accounts that's required minimum distributions to 73 in 2023 this year, from 72, and 75 in 2033. So we're talking 10 years out. but I like that. I think that's yeah, anytime you give people more flexibility in terms of when they want to get that money and hopefully manage what the tax liability is by pulling money out of the retirement accounts, I think that is a good thing. Also decreases the penalty if you don't take your RMDs. Right now, you get a 50% penalty if you don't take your RMD. It increases it down to 25%. Catch-up contributions in 2025 basically will get coded depending on your income levels as Roth as opposed to traditional. Bad from being able to deduct it today, but really good for building Roth assets down the road. And the other kind of cool thing too for people that might have overfunded 529 plans, if you put a bunch of money into a 529 plan, there's too much money in there. You actually have the ability starting in 2024 to pull at the annual contribution limits, but up to 35,000 out of 529s, put it into a Roth IRA for those 529 beneficiaries. So you can basically flip it out of college savings, education spendings, flip it into long-term retirement savings. I think that's really cool because there are a lot of, overfunded 529 assets out there. In the past, you just take it out, you pay the penalty, you name a different beneficiary, or you put yourself as beneficiary and go to Golf Academy or something like that. But the fact that you can now turn that money into retirement savings, I think is a really good thing. So that is Secure Act 2.0. We can get questions on that. Any other questions? We only had a few today, but the ones we had are really, really good. Anything else? I'm going to give it another minute or so, and if we don't have any, then I will thank you all for popping in here. No one has left the room yet, so I'm guessing everybody is waiting for someone else to ask the questions. In any event, yeah, while I've got you on here, again, really just want to remind people we're putting a lot of stuff up on our website. It's in the resources tab. We do a podcast in here. We have a YouTube channel. We answer, as we did one on Secure Act about a week and a half or so ago. As these issues come up and we get questions from clients, basically do a little video, answer those questions, and load it up there. So it's a pretty good resource. Again, we haven't been emailing it out to clients. We don't want to fill your inbox, but we do want you to know that's out there. Okay, we got a question. Don't forget to it's Andy. Okay, yes, Andy, who you all know if you're a client, said do not forget to show the disclosures. Thank you, Andy. So these are our disclosures, which come along with the slides. But that is true. It's a great point. Anything else? And Andy, thank you for watching my back on the compliance disclosures. He's giving me the thumbs up in the other room. All right, let's give it, going to count it down for about 30 seconds. Any questions? All right, if we don't have any more questions, I really want to thank everyone again for joining me. We'll do another one of these probably in April. And again, it means a lot to me that everybody just find some value in what we've got to say, and appreciate you all joining us today. So wherever you are in the country, take care, and I'll talk to you. Oh, last thing, one housekeeping thing. If we have not done a review for you since, let's say, October, we've been sending out, we've been reaching out a lot. We were done most of these year-end reviews. Please let us know when a good time is. Virtual, in person, we're doing it pretty much every single way now. If we haven't done a review, we definitely would like to get those on the calendar. I got one more. It's a thumbs up. All right. Thank you very much, everyone, and we will talk to you soon.